Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, one of our brilliant up-and-coming portfolio managers. So happy to have him along this week. We've got three topics to cover for you. We're going to return to something we talked about last week, the labor market, something that's really at a critical juncture. So we really want to take all of this data in and give it the time that it deserves. So we're going to talk about the U.S. dollar, potentially at an inflection point. And then Zach will wrap up and talk about the volatility we've been seeing in the tech space. So let's jump right into the labor market. Last week, if you'll recall and happen to join us, we talked about the number of layoffs that were announced by Challenger in their report. The good news is in the month of January, there was a lot of hiring that took place. So at least temporarily, there was a good a month and perhaps a turning point. Meanwhile, we're going to talk about the annual revisions and where these come into play. When we get the monthly number from the Department of Labor each and every month, first Friday of that month, what we're getting are estimates. They're estimates from surveys that they send out to businesses and households and combine that for various pieces of data. And so obviously you're getting just a glimpse, and that is then formed estimates for what happened to the rest of the economy. But as you go through time, that can drift from what's happening underneath the actual economy. Meanwhile, throughout the year, of course, the states have actual tax filings and other real data that come from businesses. So at the end of the year, these are combined, and what we have is an annual revision. So we find out how the job market really is as they restate the prior year. And this year, what we saw was the same as last, is a pretty marked revision, marked down from the number of jobs that were previously reported. You can see the top on the top left panel here, the black line are those monthly numbers as they roll in. The orange is the revised. So nearly 1 million jobs taken out. And these aren't people, by the way, in the Department of Labor doing a bad job. It's just simply the limitations of how we survey and the estimates that had to be made within it to come up with those numbers. Some other things that are interesting are in the bottom. If you look at the bottom left, the healthcare sector, which would include social assistance, so the thing like home health care would be included. That is responsible for nearly 100% of all net jobs over the past couple of years. So truly surprising. The middle panel there are where we would label white collar jobs, financial services in the black, information technology and the orange, as well as the professional and business services. Each of those are basically in decline, and this would likely be the group mostly at threat from AI. So that is an ongoing theme, and the manufacturing continues to be in a decline. So that's the annual revisions. Like I said, the month of January, before it gets revised, was relatively healthy at 130,000, and in this day and age, with where we are population-wise, that's a big number, and hopefully that is going to continue. Now we're going to shift gears a little bit and talk about the U.S. dollar. Something that has to always be on our radar. Where the dollar is going up or down relative to other currencies is so important for things like whether international stocks are outperforming the U.S. in dollar terms, the different types of sectors that benefit, commodities that are priced in U.S. dollars. So the U.S. dollar is a major player for which asset classes are doing well. And the dollar, top panel, is just the index of the dollar against other currencies. We peaked in 2022. But have been sliding and reverting then. And this is a boldly stated goal by the administration. And I think for whatever it's worth, a good goal. The dollar needed to have some air let out from underneath it that allows us to compete more on the export side. And that has been reversing. But what we're looking at in the bottom is some turning point perhaps on large traders. Large traders are the banks, and other commercial players that often can signify turning points when they either go long, when that green line is going upwards, or short, if it's going downwards, it can be a negative sign. But previously, when the large traders build up long positions, has been bullish for the U.S. dollar. So while we've seen the dollar give up some ground, large traders are finally re-entering on the long side. So something that we have to be cognizant of for our positioning. The dollar slide here has actually been a pretty good thing for our portfolios year to date. So certainly we want to have our ears if we see other confirmation of that data. So that's that. And I'll turn it over to Zach to talk about the tech sector and its volatility.
Yeah, we've talked often over the past few years here about concentration in the equity markets, particularly in the top part of the equity market, the Mag 7, the Mag 10, or even broadly the tech space. And so the chart on your screen here is two different subsets of the equity market, the tech plus sector. So there'd be your tech names, and then things like Amazon and Tesla that technically aren't considered technology but move like technology. And then on the right panel is your Mag 10, or the biggest 10 names in the S&P 500. So what you see, the trends that it's showing in red are the weightings of each of those subsectors as a percentage of the overall S&P 500. You can see that the tech plus sector is now eclipsed weighting wise where we were pre-dot-com bubble. The Mag 10 concentration continues to move up. It's now over 40% of the S&P 500. The gray line there, though, is what we're going to focus on. And it's kind of intuitive that as these big names take a larger weighting in the index, that they would control more of the volatility, or would cause more of the volatility in the index. And so that's what you're seeing in the gray line. As those spikes happen, what it's showing is that the volatility of these names, namely in the tech sector or the top end of the market in the Mag 10, as those names get more volatile, it flows through to the rest of the broad market. So the S&P becomes more volatile. It's because those names are driving so much of the performance. They have an outsized weighting on how the overall index performs. So as they become more volatile, the index becomes more volatile. Pretty intuitive. What we've talked about recently, though, namely at the beginning of 2026 through the first 6 weeks or so here, is that we're starting to see a rotation out of some of those names. We're starting to see other sectors outperform: healthcare, industrials, financials, etc. Energy would be another one of those. We're starting to see a transition from large cap favoritism to small caps, growth to value. There's some of these trends that are taking place, and they provide opportunities in the market. Now, it's going to take a while for some of the participation to broaden out, to see some of those names gain back market share and become more dominant players in the market. But as of right now, what we're going to see, or what we anticipate seeing going forward, is that as these big names continue to be more volatile, we'll probably see the overall market be more volatile until some of these trends that we've talked about materialize a little bit more and we get broader participation, which does provide some opportunity in the market for us.
Absolutely. Thank you, Zach. And thank you to all of you for giving us this time. We sure do appreciate it. As always, if we can be of service, please don't hesitate to reach out. 800-928-4001, or scan the QR code and do so electronically. Thanks again, and have a great weekend.